Hey everyone, welcome back to another video. In this lecture, we're going to be talking about income statements. So an income statement is one of the three financial statements that a company provides that reflects their revenue and their expenses over a certain duration of time. So this duration of time can either be quarterly, yearly, monthly, or even annually. So let's look at an actual income statement and discuss the key terms now. So at the top you have your revenue section, and in it you have your net sales. So in 2017, that was $229,000. And then after that, you have your cost of revenue. So here we have our cost of sales, and this is basically how much money the company had to pay in order to get this amount of money. And when you subtract cost of sales from the net sales, you get your gross profit. And here we have our operating expenses. So we have research and development, selling, G&A. So this sometimes is written as sales and marketing and general and administrative separately, but here it's written as selling, general, and administrative. And adding all these up together, you get your total operating expenses, and that comes out to almost $27,000. And operating income is when you subtract the total operating expenses from the gross profit. So that gets you about 61,000 bucks. And then here we have our other revenue and expenses. And after that, when you add these to the operating income, you get your income before provision for income taxes. And then that's basically your pre-tax income. And then after that, when you subtract your taxes from this income, you get your net income. So the net income as of December 31st, 2017 is $48,351. So now we're going to look at some ratios. And these are super important for when you're trying to analyze a company or if you're trying to make projections. So the first kind is called a gross profit margin, and this is the gross profit divided by the net sales. And in the case of December 31st, 2017, that's about 38.5%. And the higher the profit margin, the better, right? Because profit is in the numerator, so you want the profit to be as high as possible. And higher profit margin reflects higher efficiency. So let's take Apple, for example. Apple is known for its high profit margins, as iPhones cost about $400 to make and are sold for $1,000. And that's a ridiculously high profit margin. And the next kind of profitability ratio I want to talk about is the ROE. And this is short for return on equity. And the way you calculate it is you divide the net income by the shareholder's equity. So let's do a little bit of practice. So here we have an income statement of AYX. So now I want you guys to calculate the gross profit margin of AYX on December 31st, 2018. So go ahead, pause the video and unpause it when you're ready. So here's the answer. So remember that gross profit is the gross profit over the sales. So that would be 230,770 over 253,570. So that would be about 91%. And now let's look at a couple more ratios. The first one is R&D over sales, second one is G&A over sales, and the third one is sales and marketing over sales. So in 2017, the R&D over sales is 0.051, so about 5%. And since expenses are in the numerator of this fraction, these ratios should be as low as possible because it's always ideal to keep your expenses at a minimum. So here's an income statement of California Business Solutions. And what I want you guys to do is to calculate the G&A over sales. So go ahead, pause the video and unpause when you're ready. So here's the solution. So G&A over sales, that's 128,000 12,800 over 293,500. And that gets you about 4.4%. And now we're going to talk about growth ratios. So basically, the first one is revenue growth, and that is the net sales of year 2 minus the net sales of year 1 over the net sales of year 1. And net income growth or margin growth is the same thing, except instead of net sales, you're using net income. And since these ratios reflect growth, you want them to be as high as possible because you want them as big of a growth rate as possible. So now let's do a little bit of practice. So calculate the revenue growth from 2016 to 2017 and calculate the margin growth rate from 2016 to 2017. And remember that margin growth is the same thing as net income growth. So go ahead, pause your videos again and unpause when you're ready. So here's the solution. So the revenue growth rate is 6.3% and the margin growth rate is 5.8%. And that's it for this video. Thank you guys for tuning in. Have a great day.